So, welcome everybody to Chapter 5 of Financial Fitness event dedicated to real estate. Super excited to hear about this industry. Uh, let's go ahead and get it started, Mark.
So yeah, I think Ryan had a family emergency, so he's not going to come. It looks like we're missing. So we only have three speakers today, I guess, instead of five, right? So I'm not sure. I mean, I'm guessing you can take your time if you want to talk 15 minutes. Talk 15 minutes. First person up is Ben with Redfin. So feel free, Ben.
All right, everybody.
Enjoy your pool time.
Yeah, thank you. You guys are taking my Twitter Spaces V card, so go easy on me, okay? I'll give you my spiel on Redfin here. First, I want to say, give some disclosures. I am a long-term shareholder in Redfin. I'm also a retail investor. And nothing I say here is for any proprietary gain. So please do your own due diligence. I also want to give credit to James Slavitt and Mike Dalpreti and the folks at NFX, James Currier and Pete Flint. They've helped shape my opinion on this topic, and they provided a lot of insights that I'll share today. I also want to say thanks to Max and Mark for putting this nice talk together and giving me the opportunity to speak to all of you and share my love for Redfin. Okay, now I'll get into it, all right?
Drum roll, please.
All right, so I'm going to give you a little introduction. So the terms business to consumer, or B2C, and business to business, B2B, they've been around for decades, since the early days of the internet. But over the last decade, we've seen the rise of a new entrepreneurial movement. James Slavitt refers to it as E to E, consumers that are focused on delivering an end-to-end consumer experience, which is powered by a fusion of software and people. He calls these real-world software companies. They use software and technology to deliver compelling services in the offline world. Traditionally, the fundamental trait of an ideal internet business has been scalability. We're all familiar. They create a small team of people. They deliver a product to millions or even billions of people. These high-margin businesses are beautiful companies that grow very fast, but they're rarely available to us retail investors, especially at an early stage. In part, that's why I believe retail investors need to be wiser. They need to think longer term, and they need to look at the next frontier of internet businesses, E to E, or end to end. As James states, there are times in business when you need to do things that don't scale, times when good old-fashioned human touch is an essential part of the overall equation. Essentially, the quality of a company's customer service experience matters as much as the quality of its code. Net promoter scores measure that experience. Algorithms can be obsolete, patents can expire, but a reputation for delivering a great end-to-end customer experience will always endure. 77% of the United States economy is driven by the service industry. I believe technology-driven, consumer-focused, secular growth businesses will dominate the next century. The best E2E companies will be architected from the ground up and will become defining brands for the next generation of consumers. Online real estate brokerage Redfin is at the forefront of such movement in the real estate sector. Unlike their counterparts that you will hear about shortly, Redfin does not generate leads for traditional real estate agents. They don't sell advertisement, and they don't run a multi-level marketing pyramid. They instead employ a network of real estate agents across the United States and parts of Canada, and they deliver an end-to-end customer experience. We've witnessed other E2E service-related operating business models in large fragmented industries, such as Uber and Airbnb. In my opinion, the difference exists in the speed in which these service-related business models scale. Uber, for instance, is a high-frequency, low-risk model. The risk of using an Uber is about $20. If the consumer is unhappy with the experience, they risk losing only a small amount of money. The frequency of ride sharing, as opposed to home buying, is also much higher. This has allowed the Uber to scale market by market much faster than a real estate brokerage, as home buying is a high-risk, low-frequency transaction. In my opinion, this provides a long-term focused real estate investor a major advantage. High frequency, low risk internet E2E businesses like Uber and Airbnb scale in about a decade. Because their investors understand this dynamic, they decide to stay private for a large portion of that growth and subsequently a large share of the gains. Public investors do not have access to these businesses until they are at large scale. Redfin has spent about 15 years painstakingly building real estate brokerages from the ground up, agent by agent, in over 91 markets across the US and parts of Canada. Redfin agents have in-house built proprietary technology software that allows them to recommend the right home for the right consumer at the right cost. They leverage technology at every step of the process, from search to booking instant tours to a new innovative product called Direct Services, which provides access to homes with an iPhone and allows a non-agent delivered offer, saving consumers tens of thousands of dollars. Redfin's portal averages about 42 million users per month, more than 4x the web traffic of the second largest real estate brokerage website. They have a net promoter score greater than 50. They show 80% of listings within 5 minutes of appearing in the MLS and notify consumers of new listings about 18 hours faster than the other leading real estate websites. They have the most accurate home estimate, with homes sold within 3% of a Redfin estimate, more than double Zillow. Their agents make 2x the industry standard, and their tenured agents are averaging over $200,000 a year. They sell homes faster and for more money and at lower fees. They recently just passed the $1 billion mark in consumer savings. Airbnb CEO and co-founder Brian Chesky once said, "If I could do things over, I'd do things that didn't scale earlier." After nearly 2 decades, Redfin is getting close to fulfilling their quest as a full stack, vertically integrated, complete solution, offering mortgage, title, brokerage services, iBuying, concierge, and rentals with the recent acquisition of RentPath. The brokerage grows about 20 to 40% per year, highly dependent upon the real estate market. Mortgage is small, but it's growing over 200% per year, with a long runway ahead, with attachment rates reported at about 20%. It's my belief that this large journey on the flat part of the S growth curve may be near an inflection point and should provide decades of growth in the largest industry in the world. The key, and I'm going to emphasize this point very clearly, the key, in my opinion, is to watch the growth of Redfin Direct Services. It's the best way to dramatically change the unit economics of the real estate transaction. The margins for Redfin Direct are upwards of 90% and could potentially create a major flywheel of growth for mortgage and title. A prudent investor may watch on the sidelines until/if Direct Services reaches escape velocity. In my opinion, this is the real opportunity. If open to third parties, it could allow Redfin to scale much faster than their operating costs. I believe it's the path to creating the Holy Grail, which is a two-sided real estate marketplace. We've all witnessed Amazon in retail, entrepreneurship with Shopify, and Carvana in car buying. I believe real estate is next. I think the winner of real estate will be a missionary CEO with a deep focus on consumer experience and operational excellence. My bet is on Redfin. Thank you.
That was perfect. Thank you so much. Short and sweet. I think I'm using a Redfin platform every single day at work. I'm a credit analyst, do a lot of work for commercial real estate and residential real estate. So I've been using Redfin for the past 3-4 years. So I'm very familiar with this firsthand, I would say. Great presentation, Ben. Thank you.
Absolutely, you're welcome.
Hey, Ben, great job. I'm curious. I have a question for you.
Yeah, buddy.
How did you of your growth portfolio? what led you to that decision where, I want to put all my money into this company and I trust the CEO or whatever it may be?
All right. I'm going to be very honest with you. I've had 2 home runs in my investing career. My first home run was Amazon. It was one of my very first investments. I put a pretty decent amount of money into Amazon. I studied this business inside and out. I studied what made these people great, how they scaled this business, their long-term focus, their constant emphasis on the consumer, a better product for the consumer over and over, and then dropping costs and leveraging technology. And Bezos tested. He never brought out a product without testing it. He would test, and then grow. I then took that, and the first time I ever heard Toby speak at Shopify, I started hyperventilating. I mean, I couldn't believe this guy existed. I mean, I went to my wife. My wife had to talk me out of taking the 529s out of our kids' college fund and not putting it in Shopify. I mean, the clarity in which Toby spoke and his vision was just spot on. So I bet pretty big on Shopify. I then in 2014, and so Shopify sort of overlapped some with Redfin, but I started looking at Redfin 3 years before they IPO'd. They IPO'd in July of 2017. That winter, so I put a little bit of money in Redfin, but I was still trying to test it out. I'm not a guy that just jumps right in. The winter of 2018, Redfin made a major mistake. They hired way too many agents. They decreased the customer cost or the load cost on the agents, and their margins decreased. In August of 2018, the second quarter conference call, people thought the real estate market was red hot. Okay, they thought it was red hot, but Redfin had further looking guidance and metrics that told them no, this market is not hot. It was actually slowing down. So interest rates have went up. The sellers weren't ready for lower cost or to lower the prices, and the buyers weren't ready to increase their prices because the interest rates had went up. But Redfin, during their conference call in Q2, Glenn Kelman got on this conference call, and he told everyone that the real estate market is actually not red hot, and it's actually going down. And Redfin's stock price during this conference call dropped about 30% in 15 minutes during the conference call.
Wow.
And I sat there for the first 5 minutes. I was so pissed. I'm like, damn it, dude. Like
why are you
can't you
this?
sugarcoat this some? You know what I mean? Can't you sugarcoat this some? But what the guy did was he's honest, and he's not a BSer. Like, the guy tells it how it is. And if you watch and you really read between the lines, he's laid out the entire pathway for Redfin Direct from the very beginning. And once you figure out that you have a guy that's a long-term focused, honest human being that's willing to work on a really complex problem day in and day out, and it's a giant TAM that needs to be disrupted. I mean, real estate is really messed up, okay? And it needs to be disrupted. And once, I felt honest and I felt like this guy was telling me the truth. When that stock price dropped into the 13s that winter, I mean, I threw a whole bunch of money at it because I knew that the person was trustworthy on the other end, and I believe the vision in which they've laid out. So that's how I've come to the conviction on Redfin.
Thank you. That was a really good answer. I guess one more. Where do you see this company? I don't know. Do you see it being 100 billion? I mean, like, what's your aspirations with it? If you don't mind me asking.
Well, so I mean, I don't want to create some giant expectations for the business, but I mean, if you truly think about it, if they're able to scale Redfin, I don't know how the market's going to react, okay? But if they're able to scale Redfin Direct, so if you're able to create basically the TurboTax, that's all we're talking about. It's taking their software that they've created for their agents and making it consumer facing. I mean, that's what they're doing here. And they're giving you 23 steps to buy your own home, right? Press button, get mortgage. Press button, get into house. Press button, make offer. If Redfin takes 1% and they completely eliminate the buyer's agent. I mean, I don't know what you guys think, but if you buy a $900,000 starter home in Seattle, I mean, does a buyer's agent deserve $40,000? I mean, what do you think? I mean, do they do $30,000 or $40,000 worth of work?
Sometimes,
I mean,
yes.
I'm
So
sometimes and you're right, and that's exactly right. So I think they provide a menu of pricing, right? I think some people want a full service agent, and so there's going to be 2.5%. You're going to have to pay for that service. But I think some experienced home buyers are going to be willing to negate that expenditure and go for the 1% fee. And so I think if Redfin is able to create this very unique dynamic where they are able to pair buyers and sellers directly, and then they're able to take that and also go into mortgage and make a 7-day close on mortgage like they've talked about in some of their job listings. I mean, I think whoever is able to successfully become the two-sided real estate marketplace is going to be a massive, massive company. I mean, how wouldn't they be?
Thank you, Ben. I really appreciate it. Great job today. Thanks for coming. Thanks for sharing your Redfin knowledge. We appreciate it. Probably going to open it up to questions at the end. If you're willing to hang out, you let me know. Okay.
Absolutely.
Moving on, I think we have Daniel with Simon Property Group. Definitely a FinTwit favorite, this one.
Yeah. Hey there, everybody. So when I look at investing in general, I try to find the best in class in the area I'm investing in. And in some spaces, if you look at, say, retail or technology, there's going to be lots of bests. But when you look at mall ownership, there's kind of not. There's Simon Property Group and there's Brookfield and Tanger Outlets to a point is really the top tier of that industry. And there's a narrative that goes around about malls. There's this idea that malls are dying. Where did we get that idea? We get the idea because you drive by the mall and Sears is going out of business, or the very visible parts of malls. But the reality is that's a false narrative. We're seeing a shakeout in the mall sector. Crummy malls are dying. You know the mall you go to that's like mostly stores that sell cell phone cases and hats? Yeah, that mall is in a lot of trouble because there's not a lot of need for it. Department stores could be a thing of the past. The jury remains out on Macy's and Kohl's, and Dillard's, a chain that Deidre Woolard and I have talked about a lot. Deidre, who is not here at the moment. They don't seem to have any customers, but they actually have a strong balance sheet. But you go to the mall and it feels like something is wrong unless you actually look around and see how many people are there. Because if you're at an A-list mall like a Simon property, there is going to be an awful lot of traffic. Traffic at malls, at A-list malls, top-tier malls, peaked in 2019. So I know that seems like a million years ago as we've been living through the pandemic here, but 2019 was not that long ago. And even with the pandemic, during this Christmas season, at these top tier malls, the last 2 weeks of December, or last 2 weeks leading up to Christmas, they got to about 95% of those numbers. And those were unpleasant mall visits. You wore a mask, they pretended they had hand sanitation, and it was generally not all that fun to be in the mall. So think about that. The worst of the pandemic, 95% of traffic. And of course, outdoor malls, which is something Simon owns a lot of, bounce back faster. I live across the street from a Simon outlet, and there was no point during the pandemic when it was open. There were a few months where it was closed, but once it reopened, people felt generally safe going there, and you were spread out. You could wear a mask, you could get your food and eat in a spread out area. So as much as we've heard that this industry is dying, that is not what's happening. Now, have there been some bumps on the road? Yep, absolutely. But those bumps have been opportunities. So Simon has had to purchase some of its regular tenants, along with partners. And I won't bore you with the details there, but I'll give you an example. Simon is now a part owner in Brooks Brothers. And they did that largely because they looked and said, okay, there is a need for these stores. Brooks Brothers was hit especially hard with the pandemic because obviously, I don't know about you, but I haven't worn a suit very often in the last 15 months. In fact, I haven't worn
I don't think
pants very
anybody
often.
has.
Yeah, so what they did with Brooks Brothers, and they said they looked at the inventory And they said, why are they selling 17 different suits? Why not just 4? And they simplified everything. And I'm making up the numbers, but they simplified everything. And they know exactly who the customer is. They know who's coming into their mall. And they're not going to buy every struggling retailer, but they've bought quite a few because they can sort of provide their own tenants. So that's part of the evolution of the mall. We talked about department stores a minute ago. So those are generally the big end caps of malls. And in the old days, those were the draws. You went to the mall because it had a Sears, and then maybe you went to other places. Now the malls are having to evolve what those things are. So in some cases, they're adding residences. Well, why do residents make sense? The mall here in Boca, which is not a Simon Mall. That mall, the Sears closed, and they're putting in 350 or so upscale condos. In Boca, that probably means like $5,000 a month, 2 bedrooms. Well, those people are going to go eat at the restaurants in the mall. They're going to provide sort of an undercurrent of customers for that mall, and it doesn't sound like a lot, but if you add 50 or 60 dinners a night across 3 or 4 restaurants, that's actually kind of game changing, and it makes sense. But it's not just residences. There are malls adding hotels. There are Simon properties that are adding grocery chains, gyms. Now think about it. If you're going to the mall and at the end of your trip you can go grocery shopping, do it at the end, not at the beginning. That would not work. There's more reasons to go there. They're also adding experiences. You're seeing, Simon Malls add like mini amusement parks or pools or ice skating rinks or Ferris wheels and who knows what kind of attractions. You're also seeing things like food halls. Food halls have had a lot of bluster. They actually haven't shown to drive people to the mall all that much, but you're going to see event spaces. The Simon Mall near me, has like essentially concert space. The area where the Easter Bunny appears is used for other things the rest of the year. Obviously, some of these things not happening during the pandemic. Simon Property Group has returned to being profitable. That sounds that's pretty astounding given where we were with the pandemic, where there was a period where an awful lot of tenants weren't paying rent. I used to joke the most strategic not paying rent was Cheesecake Factory, because basically, if you're a Cheesecake Factory, you pretty much know the mall's not going to want to take your space over because of the amount of work it would take to make it look not like a Cheesecake Factory. I call that the IHOP theory, because whenever you drive by an old IHOP that's something else, you always know it used to be an IHOP. And I feel like that gave Cheesecake Factory a lot of negotiating room. But occupancy was at about 91% as of March 31st. Base minimum square rent per foot was $56.07. That's actually a slight increase over last year. This company has strong liquidity. They have more than $8.4 billion. Only about $1.5 billion of that is cash, and about $6.9 billion is available under its borrowing and its revolving credit line. So this is a company that, as other smaller mall chains struggle or other retail properties or adjacent properties come up, they're going to be able to step in. It would not shock me if they ended up owning some of the movie theaters and other things that are on their sites. I'm not entirely sure they'd want to own movie theaters, but maybe they can use those locations, for other things as well. Of course, this is a REIT, so it is a dividend-paying stock. They paid $1.30 per common share at the last time, and again, that seems astounding when you looked at where they were. So they are bright about the future. There is going to be a lot of opportunity for this company as the retail nature of the United States changes. So, are we going to see a lot of pain? Yep. A lot of second and third tier strip malls that used to house the Toys R Us or the Circuit City. Those might turn into residential. They might turn into Amazon warehouses. But we like experiences. Like, I don't buy a lot at the mall, and that maybe is a problem for some of the retailers. But we go to the mall either 2 or 3 times a month if you count the outlet mall across the street. And maybe my son gets a pretzel. Maybe I pick up one of the 2 shirts I wear. Maybe I buy a pair of sneakers or something. But we're absolutely going. And at no point have I been to the mall, even during the worst of it, where I felt, oh boy, this is not good, except the one time I went to one of the very crummy malls by accident. And yes, you could see what was wrong there. So Simon Property Group is not a big holding for me. It's not going to be a 10 bagger. But this is going to be a steady performer that pays a dividend, that is a nice piece to own, and it is a much more secure company than you would have thought it was at the beginning of the pandemic. Questions?
Yeah, man, that was good. Just curious. You said that you have Simon Property Mall right next to you. Is it like fully open and operational right now?
Yeah. So the Simon Outlet Mall across the street from me. Um, I don't know how long it was closed. Just a few weeks at the worst of the pandemic. And they're actually adding stores. So they've had a couple of closures, but the closures aren't because of the mall. The closures are chains that have decided to go digital only. And basically, if something's empty, it there's a sign up within like 3 weeks telling you what's coming in. Like there was a Caribou Coffee that opened right before the pandemic, and it wasn't, in my opinion, a great location. It didn't have a lot of seating. There's a Starbucks pretty close by, and that closed during the pandemic. And now it's a restaurant that sells grilled cheese. But they also added some really high end. Ralph Lauren moved in during the pandemic. So again, I'm only speaking of one mall. But as these second tier malls close, there's going to be things looking for a home. I'll give an example. The mall in Boynton Beach here is a terrible mall. It's like a third vacant. There's nothing going on, but it has a really cool comic book store and it has a Buca de Beppo. Both of those are likely to look for new locations if that mall was to become a parking lot or whatever else it happens to be. So the strong malls like Simon are going to benefit from chains. They're also going to benefit very strongly from the pure digital companies that are looking for traffic. So,
Right.
if you're Warby Parker, if you're an Untuckit, you've learned you need to have a physical presence. And not every one of those is going to go into a mall, but a lot of them are. You're also going to see, I think, a lot of those retailers go into some of the surviving department stores where your J.C. Penney's of the world will add a section that sells you whatever, a fancy home gym or something. So you're going to see a lot of co-location. You're going to see a lot of experimentation at the mall. I think we have some stores at the Simon Mall near us that my guess is aren't profitable, and there's more leeway maybe on rent and leases and short-term leases and things like that. So this won't be like linear, obvious everything is great at all times, because we don't exactly know what retail looks like. We don't know, if you're Casper Mattress, do you need 50 stores or 400? They haven't figured that out yet. But the best malls are going to have the people, and that's where people are going to want to be.
Yeah, and if I'm not mistaken, I think they also own multiple malls outside of the United States, right?
They do. I don't have that much experience with those because, of course, I haven't been to most of those.
Yeah, I think last year they were trying to purchase a huge mall in Thailand. Yeah, somewhere like in that area, if I'm not mistaken. Yeah, they were trying to buy a lot of pre-COVID. I mean,
Yeah, and obviously retail is, in some ways cultural, so I'm sure there are differences, but this has also been a company that has very deep management talent. They've brought in some executives from some people they've acquired. So I'm fairly confident that wherever they're operating, they're going to be able to figure out how to operate in that market.
yeah. Do you know anything about their department, like Simon Ventures? They also own a bunch of other, like they have sort of like a portfolio, right? That they
Yeah,
invest in.
yeah, that's where like Forever 21 and I forget the jeans company, that there's a handful of retailers they own. And again, when you look at why a lot of retailers collapse, and poor Anand has heard me tell this about Toys R Us, but Toys R Us didn't collapse because it wasn't a good business that made money. It was a company that had taken on too much debt to cash out its owners. So, you have a lot of these companies that took on debt, not for inventory, not for expansion, not for, where you break it down to the core operations, they might not be hugely profitable, but they're profitable. They're money makers. And if you're Simon Property Group, you don't need to make a ton of money off your stake in
Because
Brooks
you own all
Brothers.
the real estate.
You need Brooks Brothers to pay its rent.
Yeah, 100% agree. Well, you were saying that like you don't think that Simon Property is going to be a multi-bagger buy. If you would have invested, I think last year when it dropped like all the way to like $30 or like $40, now it's 120. So it's a pretty nice return if you ask me.
Yeah, here's the thing. I said I don't think it's going to be a 10 bagger. I would argue that it probably will be a multi-bagger
Yeah.
over the next 5 to 10 years. But it's and if you factor in the dividend as well, this is just a nice, safe stock to own that is I think nationally at some point we're going to get over this notion of the retail apocalypse that we don't want to go to stores. Like, I will be shocked, and
No,
I'm on the
I
record
agree
saying
with you. I
this.
think everybody wants to go shopping again. I mean, yeah.
Yeah, I mean, I'll close with saying, like, I will be absolutely stunned if retail sales on the internet cross 20% within the next 5 years, unless we have another pandemic or something that forces it. But there's a reason we go to the store. Like, I use all of those services, and when I added up the amount I spend in stores, it's way higher than what I spend on Amazon. Even though I order from Amazon, I don't know, like 2 or 3 times a day sometimes.
Yeah, just like they say that the future of retail is not e-commerce, is the retail everywhere.
Yeah, absolutely. And that's something that I think Simon as a company might have to start putting together some services for some of its retailers. And they did some of that during the pandemic with organizing curbside and other things like that. I could see a Simon Shopify partnership as making a ton of sense, because obviously Shopify is building out all that logistics, and they're sort of the Amazon if you're not Amazon. So I think it's a really exciting time for this. And look, we're always going to want a Cinnabon.
That would be pretty cool, actually. I know Tall Seller is getting pretty excited by hearing about Shopify. I see him in the room here. Yeah, that was great talk. Thank you so much. Even though this name is not highly talked about and discussed about on Fitwit, I think that it's a stable performer, and plus, like you said, it also pays a good dividend. So why not?
Yeah, thanks, Dan. Appreciate your time.
Thank you.
Cool. We're going to move on. We have a nod now who's going to talk Zillow.
Great. Thank
Thanks
you to
for
both
coming.
Max and Mark for putting this together. And I'm excited to be on here with Ben and Dan and seeing a lot of folks that I love following. So I'll try to make this good. First, the worldview, my personal worldview is that basically for housing, and I believe in online disruption, right? And obviously Ben does as well. I think the losers here ultimately, or slowly over time, are the traditional real estate agents. And I think there's a lot of kind of pie left to take over from those folks. I'm a big fan of both Redfin and Zillow in my personal portfolio. I own pretty equal amounts of both. It's kind of a pair for me. But I've been diving in deeper into the industry across many companies to kind of get that breadth. And I've been surprised that Zillow has kind of, before I was more bullish on Redfin, largely because it's about 1/5 the market cap of Zillow, so there's more room to run. But Zillow is a $30 billion company. I found that it's my number one play in housing. So let me give you the bull case on Zillow. Ben talked about Amazon and Redfin a bit. I actually think Zillow is the Amazon of online housing. Amazon gets thrown out a lot as a comparison, but Zillow really is the everything store when it comes to online housing. They will do everything, and people criticize that, but I think it's a favorable thing that they're taking bets across everything, and so no matter how it evolves, as long as it evolves away from the traditional model, I think they can win. And I think they're aggressive, and they can kind of put more and more of their chips in front of whatever's working. So what do I mean by doing it all? I mean, they will buy houses, they'll sell houses, they'll do mortgage loans, they'll do rentals, they'll do additional services, currently title insurance and escrow. They talk about looking into home insurance, warranties, renovation, moving, and they'll do this either through third parties, which is kind of their traditional lead gen, or increasingly by themselves as a first party. We know Amazon has that and has been able to kind of thread the needle there on their first party and third party stuff. That is definitely going to be an area of push and pull there. But I think Zillow, especially since they have the scale, I think they'll be able to thread that needle. So we talked about scale, or I mentioned scale. So that's one of the big things. I'm gonna hit a few of the advantages of Zillow here. Scale is perhaps number one. It's the top real estate website in the U.S. 221 million monthly uniques For comparison, that's almost 5x Redfin's traffic. It's got an early mover advantage in the online disruption of real estate. It's a 29 billion market cap and over 3 billion in sales, and it knows it, and it's using that scale as a weapon by pushing growth outside of pandemics. If you even with the pandemic, its 5-year sales growth rate is compounding at 37%, and we already talked about its everything strategy of just going after stuff. It's got a data advantage. Zestimate's, fueled by a database of 135 million U.S. homes. A quarter of these have been updated by users, i.e., homeowners making it better for Zillow. No one wants to see their house not have the proper square footage that it needs, or be dinged for something that they believe it doesn't. So there's kind of that, you get that Zestimate email, and you might react if it's not where you want it to be. They've been working on this for 15 plus years with improvements, right? And I admit that, I used to make fun of Zestimates. You get them in your inbox, and they were so wave your hands in the air, wave your hands at it. But now they talk about a median absolute, this is a quote, median absolute percentage error of 1.8% for homes listed for sale. So what does that mean? That would mean for a 200K house, you're talking plus or minus $3,600. For a 500K house, you're plus or minus 9,000. That feels like a reasonable area there. Now for off-market homes, it's 7.4%. So that's not super close. But again, they're working on, and the data keeps getting better. And I see this, my experience now versus a decade ago. The next thing is brand. They brag a lot about Zillow being Googled more often than real estate. Oh, by the way, for anyone interested, you can go to my my Twitter timeline. I posted this. I'm working off of a deck, so you can get the whole deck there and follow along or look at it later. And you can see better pictures than I can say with words. So I've got like the Google Trends on this slide. So Zillow is Googled more than real estate, which is pretty amazing. When Saturday Night Live makes a housing skit, guess who they make it on? They make it on Zillow. And then, we talked about the Zestimate. That might be the best kind of brand name in the space. Leadership. Co-founder and CEO Rich Barton. Super, super impressive, because he also founded Expedia and he co-founded Glassdoor. So to have a third successful, big time enterprise is really rare. You hear the term serial entrepreneur all the time. Usually it's just a bunch of failures and one big win. This is a serial entrepreneur who just keeps winning. And he's been on the board of Netflix for almost 20 years. That's before Zillow was even around. So the big question I've had over the years about Zillow is, why directly buy and sell homes, right? So the first obvious answer is you're talking trillions versus billions. The TAM for all U.S. real estate transactions is 2.2 trillion. For just real estate related ads, so the lead gen, it's 19 billion, which is a nice number, but it's not it's not trillions. And it's also why does Redfin go after it? Why does Open Door go after it? Because of that. And then the second answer is vertical integration equals a better customer experience. Zillow has a great slide that kind of compares itself to, basically, it's trying to get to one click type of thing, just like an Amazon of, hey, one click you buy, or you don't even have to click, right? Obviously, you'll always have to click with a house. You don't want your house automatically selling without your permission. But they compare themselves to various companies, including Amazon, of course, but also things like Uber and Lyft, and things like Netflix or Airbnb or Carvana. They want to make it easier and easier and easier for someone to buy a house, and clearly Redfin's doing similar things. But I think Zillow's doing it better and will continue to innovate. So question is, right, isn't buying and selling houses super risky? Yeah, it can be. I like how Zillow is doing it, and I don't think it's as risky as I would have, originally guessed, right? Uh, it's got around 10% of the sales price to play with between getting, if you go to their site, they take 6% of the selling costs, just like a traditional one, traditional agents, 1 to 2% for closing costs, and then a Zillow service charge, which averages 2.5%, but there's some kind of spread there where you can go as high as I think it was like 7 point something percent. So you add all those together, that's around 10% of the sales price. Obviously, you have to potentially pay off other agents, and there's closing costs, things like that. But as you vertically integrate, you can keep taking the actual costs that you pay down and down, and then that also gives you a little margin of safety on, hey, your Zestimate's wrong, right? So the second thing is it's net cash, so it's cash minus any debt it has. That net cash is 4x its housing inventory. So it's got a lot of margin of safety there. And then those estimates, we talked about the data, keep getting better. And for now, they have human oversight over those estimates. It's not just, hey, whatever your estimate is, that's what we're going to buy it for. Although they are testing Zestimates as your offer in certain markets. That's very small right now, but you can see if they can actually crack that and make sure that they're not going to get hosed with that. I mean, talk about easy. You don't have to. How many times have you gone to try to get if you own a house to get a mortgage refinance, and you want to get those rates, and you got to give all this personal information, and they take you through 20 screens because you're thinking, oh, I can just put my email address here and they'll give it to me or whatever, and they just keep asking for stuff. The ability to go to your house, look at the Zestimate, and say, oh, that's what they're offering. I can bump that against my time and all the risks that I'm going to take. Getting 0 days time on market instead of what the traditional over 2 months takes to sell a house, and to be able to move whenever I want, and to have Zillow take care of repairs. That's really compelling. So the bottom line is I'm very bullish on Zillow. Has the early mover advantage, and with that scale, and it's pressing it fast. And so even near 30 billion in market cap, I can't believe I'm saying this, but I have more faith that it can 10 bag than its smaller competitors.
Wow.
That's all I got.
Great work, Anand. Thanks so much for coming. I have a quick question for you before we open up the audience. So I know you share your is it the green light framework? Is that what it's called?
Yep.
I think so. I know you share that. For the listeners, I'm going to be kind of curious. Do you mind explaining that? And then do you mind scoring Zillow in that system?
Sure. Sure. I may have to punt because I meant to put that actually as the last slide on this presentation. But I'll kind of,
or just
verbally
kind of explain. You could just explain the system if you don't have it. That's okay. No big deal.
Sure. But yeah, the system is, I ask myself 5 questions, and you can see the scale pinned to my Twitter timeline. But it's 5 questions that I ask, and I kind of color scale it from green is good and red is bad. So if you take sorry, I'm just pushing in here for the question. So the 5 questions are: the upside, will it 10x, and can it 10x in 10 years? So I'd have Zillow as a dark green. So even at that 30 billion market cap, which is much harder than if you're talking about a 5 billion market cap type of company, or a $1 billion market cap company. The downside, how low is the floor? Because of the strength of its balance sheet and how how entrenched it is, and my confidence in leadership. I'm probably at a light green or something thereabouts. I'll formulate my thoughts, better. The wow, the most important thing is probably just that scale and that branding that they have, and just the opportunity. There's probably 3. I try to get it to 1 wow factor, but there might be 3. These are the things that the wow would be. We were talking about Shopify earlier. That's the Amazon stopped competing with them. Holy moly. I need to get into that. And then those 3 are stock specific: the upside, the downside, and the wow factor. The last 2 are kind of person specific, so Anand specific here. How excited am I personally to own it for 10 years? I'm pretty excited, so it would be a green of some sort. And then confidence level in my assessment, I'd say because I'm a mile wide, a few inches deep. I like that pattern recognition of companies, and I diversify. So in this space, I'd say I'm a yellow or a green, light green on my confidence level. Over, it'll grow even more over time. So that's a very long way of saying those greens, mostly green and a lot of dark green. That's a really, really high score for Zillow. By the time I'm currently trying to run through all the 140 stocks that I own, and that's probably going to place it in the top 10 or 15.
That's quite a portfolio, man.
I mean, so it is position size, right? So the top 20, I think, have 50% of the portfolio.
Just curious, is Zillow the only company that you own from real estate sector?
No. I own Zillow and Redfin. Both are like 2% each, which is high for me. And then I do own Open Door and EXP, but they're much smaller parts. And I like them. I like the potential upside, but I don't have that conviction that I do with the other two. And they're not at the they're not at that point where I'm like, oh, this is a I'm very confident in the potential for a win.
Do you mind? So I'm curious. I think if I remember correctly, you've been investing since the .com bubble. Is that right? Somewhere around there. How did you get to building this green light framework? And what made you decide you want to own over 100 positions? I just kind of want to understand your background, if that's cool.
Yeah. Some of it's just, hey, look, I want to protect myself, and it's why I have a quarter of my portfolio's indexing. It's just trying to be humble and not. For me, I'm a good saver, and I've done it for years, and I'll continue to. So my real risk is getting really cocky and arrogant about my thing and my stocks that I love, and say I'm only going to own 5 stocks and that's it. And I missed something, right? I mean, especially in this pandemic year, there are things out of your control, even if you're spot on your analysis. And I just like a lot of companies where I want a little skin in the game on things. Now there'll be a lot of them are much smaller positions. And in terms of the green light framework, I try to be very practical on, because I'm a big, oh man, I'm gonna go run 50 miles tomorrow, and then you don't get off the couch, right? But with a 5-question framework that's color coded and that you can quickly, you can be as verbose or as tiny as you need to be, that'll actually do it. And then kind of it's my investing journal where I can have a spreadsheet, I can rank order things, I can go back in time, so I can look at, if I've ranked a company 3 times on this framework over time, I can see how I've evolved, things that I missed, maybe 5 years ago when I first looked at a company, what did I miss, right? And what have I learned? And what does that tell me about the stocks I'm looking into today? What am I potentially going to miss? So I love it as a feedback loop, and it's really fun to share. I like color coding because it's just, I can quickly see, right? If I see a lot of red, I just know I don't need to spend a lot of time, re-looking at a company.
Thanks for your answer. That was a great answer. Max, any other questions for him or no? Or do you want to open it? What do you think?
We can go ahead and open to the listeners. And I was just really impressed by Zillow as well. Along with Redfin, I use Zillow pretty much on a daily basis, and it helps me a lot to do my job. And I've been really impressed how aggressive they are when it comes to hiring. I think they've been hiring like thousands of people. So they are growing very aggressively. I like this part of the business.
This year, they're going for a net 2,000, and if I've got the number right, they have less than 6,000 employees.
Wow!
So that's fast.
Yeah, I just learned they actually also own Troya. Yeah, if I'm not mistaken.
Yep.
Yeah, another big real estate site as well that we used to work a lot. So I already have like 4 or 5 people that requested to speak.
Nice.
And I have like 4 DMs.
I was gonna say, sorry to cut you off, Max. Thank you, Ben, Nod, and Daniel. You guys are kind of our guinea pigs for the smaller speaker size, more time, and then opening it to Q&A just so people can kind of pick your brains. So appreciate you guys, and thanks. Go ahead, Max.
Right, let's go ahead with Maximilian. I just approved him as a speaker. It shows that he's connecting. Maximilian, you're a speaker. Can you hear us?
Hey, how's it going, guys?
It's going
Man,
good.
Thanks.
Appreciate the discussion here. I just wanted to ask, I guess primarily we're talking about the comparison between Redfin and Zillow. I myself own both companies, a little more Redfin than Zillow, but it's kind of synonymous that, the idea is that, real estate is ripe for disruption, and these companies are doing just that. I have a couple questions based on two criteria that I want to see kind of play out in the next decade, which is commercial real estate as well as internationalization. So, like, how do they replicate the current disruption, the current market share growth in the US overseas? And I just kind of want to just pick your brains if you guys have looked into that. I know that they're kind of moving state by state in terms of adding ancillary services and moving into Canada, but I just wanted to know kind of where do you see this potential in overseas markets?
I can talk a minute about that. As for commercial real estate, I mean, CoStar has a pretty tight grip on that. I would be somewhat surprised if Redfin or Zillow got strong into commercial real estate. For international, so I have a partner that I have done all of this with, that I've come to massive conclusions. We have 5 and 10 year analysis on where we think Redfin and real estate in general is going to go. This person is an extremely intelligent human being who I respect quite a bit. He's an MIT grad. He runs his own fund. He's a former Google engineer. He believes that Redfin will eventually license all of their technology in which they've created that they do for their agents. And he believes that they can license that technology internationally. I don't know if that's the case. I must be honest. I think that the total addressable market in the United States is so incredibly huge that I'm not sure they go that way. But that's his thoughts, is that eventually Redfin will ultimately take all of this proprietary technology that they've done to make agents so efficient, where they're doing 34 transactions a year as opposed to an industry that traditionally does 6. And they're going to take that Uber style bookings and all those sort of things that they've done, those smart contracts that they've made consumer facing, and license it. I'm not as confident, but we'll see.
I don't have any great, huge insights on international. I tend to agree on commercial. That would be a harder nut to crack for a Zillow or Redfin for many logistical reasons. Internationally, I kind of view it as that would be a cherry on top. I generally assume with a U.S. centric business that, hey, they're if it makes sense, yeah, there's international opportunity, but it'll be harder, right? There'll be roadblocks and things you got to overcome. They're still growing in the U.S. So that's kind of a cherry on top. I think for both companies, the thesis plays out if it's U.S. only, which is exciting. When you can just win in the U.S. and you're good, and then have that international opportunity as a bonus. That's amazing.
Max, one more point, buddy. All of the people that I speak to that are from other countries, they look at the American real estate, the fact that we pay 3% on a buy side and 3% on a sell side, and they think we're crazy. That's part of this whole thesis that you got to understand that real estate is going to change. We've seen it. If you just look out into the rest of the world and you see the way real estate transacts, you know that the consumer cost in the United States is so incredibly high compared to other countries. So your point about international makes a ton of sense. Because it just shows you, once you get out of this little bubble of the US and maybe Canada, how incredibly messed up real estate truly is when it comes to cost.
Yeah, it's hugely fragmented as well. So I just wanted to see if you guys had some tidbits about that. I agree with commercial as well. It's going to be tough, but I just see as like, another opportunity, if they've figured out the residential side of it, that commercial has been, particularly rather closed doors. So I think that'd be interesting. I also think that selling their software as a service to other firms, and whether that's international or not, could be pretty exciting. I don't know about selling the data, but the software for sure as like kind of a white paper thing. Appreciate your answers though, really helpful.
I'm still trying to figure out the full impact of the pandemic on commercial real estate with all this work from home, and it's interesting to see how it all plays out.
EXP is kind of, I don't, again, it's a small position, but I think they were talking about, I think they just started opening up to commercial real estate. That makes more sense to me, where, hey, you're just, you've got this, I think Ben talked about, it's a multi-level marketing pyramid. I mean, you've got your agents recruiting other agents and kind of getting some of their downline from that, which worries me a bit. There's definitely things to look out for there, but you can see that expanding to commercial real estate, that it would be a scalable model, at least if it's a truly resilient model. Obviously, you're going with traditional real estate, but at least if you believe in that kind of disruption, and that both digital and analog, or can kind of, or physical can kind of coexist, kind of like what Dan was talking about with, hey, there'll still be shopping malls and places where you can experience things in addition to getting 50 packages from Amazon a week.
Yeah, I'm actually really curious to see, like I said, how it all plays out, and it's actually, I think it's gonna benefit consumers, because all of the malls right now will have to work extremely hard to bring all the people back inside. So, and by creating all this very cool experience, and kind of like give them extra incentive to come back to the mall by creating entertainment, and like Dan mentioned, bringing grocery shopping and movie theaters, and so it's definitely going to be interesting.
I only have a couple more minutes. I just want to say, Monday night we're going to have a chance to speak with Ho Nam. I don't know if you guys are familiar with Ho.
Nice.
Yeah, it's going to be, I think, fantastic. He asked to get together and to speak, and so we're going to do that Monday night at 4:30 Eastern Standard Time. I'd love for somebody to ask him that question about Glenn Kelman versus Rich Barton.
Let's go.
I've heard in person. Can you hear me?
Yes, we can hear you. Mm-hmm.
I've heard in person a little bit about what his answer is. But I'd love for people to
he's picking Glenn. That's my guess, just based on his tweeting.
Right?
Yeah, let's see. Let's ask that guy. I mean, that guy is. I can tell you, he's everything you see online. He's legit. So, somebody ask him that question Monday night, please.
I'll be there. That'll be cool. Thanks.
Yeah, absolutely.
I think
just add it to the calendar.
Ben, no worries. Like, drop out when you have to, and I mean, if not, and Daniel are still cool to answer some questions. I think Chris is going to go next. Chris,
can you hear us?
Me okay?
Yes,
we can hear you. Mm-hmm.
Oh, excellent. So yeah, I was happy to jump on this. I was finishing up the gym and I got the little tweet, and so here I am. So I'm in real estate. I work for
Hey, Chris, I think you're cutting out a little bit.
Oh shoot. Let me get next to my home here. I'm pulling up. I'll be on Wi-Fi in like seconds. I'll be in my garage, literally.
You sound fine.
So can you hear me okay? Okay. So I'm in real estate. I'm an agent. I'm with EXP. I learned a lot, especially from the Redfin gentleman, the investor. I can tell you, sounds really smart. Did a lot of homework. I agree that the services part of real estate, really more than anything, need to be additionally bringing, lending and title all in house and part of that experience, and that will add.
Can you guys hear him or?
Tremendous amount of value. I would like. Can you hear me? Okay.
It's very in and out.
Yeah.
Is it okay? I'm on Wi-Fi. Can you hear me?
Yeah. Now we can.
Okay. Okay. Great. This discussion is limited time. Where Zillow and Redfin have disrupted the consumer experience with having the consumer-facing apps, setting them up to just capture all that business, so to speak, because people go there and spend time there, and so you got smart people behind it building these tremendous companies. EXPI is disrupting the industry in a way, capturing all the talent. If you're a talent agent, you're not going to work for Redfin, get reduced commission or salaried, or even Zillow if they start offering that. You're partnering with them, with Zillow, spending money for leads, making a lot of money that way. But you know that I think that EXPI, I know they're ripe and ready to compete in time with Zillow and Redfin in that avenue because they bought a IDX company last year and they want to create a consumer facing app. You know, I think it's probably, I want to open it out there. How do you guys feel? I think it's going to be a while where, everything works in real estate in an upward market. There's kind of a saying. I mean, you can try almost anything and it can work to a degree. The next downturn, whenever it is, people with their homes, at least not yet today or not in the next 12 or 18 months, aren't going to just turn that over to an app. If there's a downturn, people are afraid and they need to sell their house, they're going to turn to someone they know. And EXP is capturing the high producing agents. The stock is tremendous fundamentals. They're growing their revenues well over 100% a year. They're profitable. They're debt free. Free cash flow is exploding. They're in 14 countries. They're I just think they're going to be the biggest brokerage in the world as far as agent count, and they're a small market cap. They can 10x easily. So for investment, I just encourage everyone to give it a solid look. Look at the fundamentals. Consider that so much talent, high producing agents, the whole downline thing. It's not a pyramid. Pyramids are illegal. Keller Williams have been doing it since the 80s. EXP just modeled that, but they share revenue versus profit. Revenue is there's so much more money in revenue versus profit later. It's very lucrative. So my 2 cents. I respect you guys.
Can I take that question, Chris? Let me answer. All right. So Glenn Sanford at EXP is phenomenal, and it's a wonderful business. I mean, look at how fast you all have grown. Look at the way he's leveraged cost, and he's used technology to make the process better for agents. I mean, it's absolutely fantastic, and the sharing of revenue is exactly on point. It's a new age brokerage designed for real estate agents. It's beautiful.
Correct.
The great thing about, in my belief, Redfin, and the reason why I'm so bullish on direct services is because I believe you're going to see partnerships between Redfin and EXP and probably other brokerages where they will then allow so EXP is going to have the agents, you're going to have the sell side, but for 10, 15, 20% of consumers who are ready to buy a home on the buy side without an agent, they've bought 5 homes before, they're ready to buy one on their own. EXP agents are going to accept a digital offer, almost like the TurboTax of real estate. And if you take a company like EXP and they accept that digital offer, where they accept it, you're going to grow faster than a company that's not, because your sell side is only going to have to pay a 1% buyer's agent fee. So you're going to be able to go to your clients and say, hey, look, we partnered with Redfin. We're willing to accept direct offers. We'll 2.5%, 3% on the sell side. But if we get an offer from a Redfin buy side, you're only going to have to pay that buyer's agent 1%. And it's going to create this
synergy.
Exactly. And, and Glenn and Glenn, I mean, 3 years ago, I put a thing on Twitter where I said, look, you two need to partner. And they both responded. Glenn and Glenn for the win. I think those two companies, they're very close together. They both know. They're both technology-driven real estate CEOs. They understand these synergies. And so if you see a buy-side sell side partnership with EXP, both companies explode.
I totally agree, and I like that idea. The understanding, because being an agent insider, my upline's pretty high up, so I chime into some of these higher level Zoom calls. I'm not disclosing anything illegal or anything stock related. The general sense that I get, could be wrong, I'm not behind closed doors, is that EXP wants to just do it on their own, wants to do it. I'm not saying that wouldn't happen. I don't know, right? I mean, you put more research into Redfin, certainly. It may be XPI than I have, although I've done a lot into it. I'm an insider, so to speak, but being an agent. But I've seen the kind of beta model, what they're trying to do, where it'd be a Zillow type consumer facing app. People don't care EXP really. They want a consumer experience. They don't care about the stock, all that. They just want to look on their iPhone or their phone and go to an app that they know, like Redfin or Realtor.com or EXP or Zillow, whatever it be called, and find a home and tap it, and that local market would contact the EXP agent, where outside agents wouldn't be able to pay to be on it. And so they still can't have that streamlined experience. They want to bring title and loan in for high margins. They've already said that. They realize it'll bring their margins up, that kind of thing. So that's coming in time. But yeah, I mean, whether it happens that way or the other way or both at the same time, I think the disruption's there. So if we're talking 10X and going forward, what's the XPI? Just a few billion market cap. I mean, the rate they're growing, they're actually growing revenues and transactions faster than they are agents. That tells you they're bringing in high producing agents, and they're in 14 countries now. They went to 4 countries in the middle of the pandemic and never took a single flight to that country. Their business model is so light. The footprint is so quick and light and nimble. They're flying across the globe. They have countries calling them leaders, real estate leaders, saying, "We want you here." We have agents that are hungry for this business model, for this experience, this opportunity. So I would say they're all exciting. And EXP Glenn Sanford, I heard it from his mouth, he doesn't consider Keller Williams and Berkshire as their competition. He considers, he said Zillow. I think you could throw in Redfin with that too. That type of company has a real competition going forward.
Thank you, Chris. I agree with you.
Great. Good experience today. Thank you.
Yeah, Chris, thank you so much for the question.
Hey, Chris, really curious, really quickly. I see you're in Nevada.
Yes, sir.
You're a real estate agent. How's the market looking? Do you still see, is it still as crazy as it was, or is it finally starting to cool down? And where do you see the market headed?
Well, it's red hot. I just sold a listing. I got another one coming next week. I mean, that's just my little corner of the world, but it's really hard for buyers. The inventory has come up just a little bit the last few weeks, but we're still at 4 weeks or less supply. The sales have slowed down, but the prices are still going up. I think at some point more people list their home, and then the prices can start bumping their head at some point, which would honestly be healthy. It is crazy, but it is red hot. But there's so much. I'll say this about it. It's so different. Everyone remembers 06, 07, the bubble. It's like your great grandparents in the Depression. They never touched the stock market. I have coworkers. I'm an ER nurse too, part time, that are still renting several years later. I've had my license. They're just waiting for the next quote bubble. And I know there's such an organic demand for people that just want a home to live in. Yeah, there's some investors. There's some, but they have a lot of money to put down. They're paying cash for it. They're not leveraging like they were 15 years ago. They're just I don't know. I don't see the demand. I don't see the demand going away. We get more inventory. Yeah, we get more inventory. It'll be healthy. But we got more Californians moving here. I have conversations with them. The work from home thing. I'm from San Diego and I want to work from home and establish residency there. And I can't afford San Diego. And he's a pharmacist making 6 figures, but $100,000 will get you a lot more in Nevada than it will there. Right. So that's what I see. I see demand not slowing for a long time.
Thank you. Appreciate it, Chris.
Yeah, there was a great insight. XPI actually was supposed to be one of the companies.
Yeah. Sorry, go ahead, Max. Go ahead. Sorry.
No, I was just about to say that XPI was going to be one of the companies presented today. So I'm very glad that we got one of the insiders to discuss this company. Thanks, Chris. Really appreciate it.
Oh, thank you. Yeah, reach out to me. I'll do my homework if you want me to, or I'll get someone online.
Cool. Thank you, Chris.
Chat sometime.
All right, guys, I'm heading off. Time to go. Tea time. See ya.
Thank you so much, Ben.
Do you, Anand or Dale, do you have time for a couple more questions, or how do you guys feel?
Happy to take a couple more questions. I can just attest to, I am not 1,000% sure that the buying and selling part of real estate needs to be disrupted, especially when the market's hot.
That's a good
So
point.
I've purchased 17 homes, I want to say. It might be 18. And we just
17?
finished
Wow.
selling our principal residence, which is a condo in West Palm Beach. We're renting because we needed something that made sense for the pandemic, but doesn't. We have a junior in high school, so the size of my household may change in the next few years. So buying didn't make a ton of sense in a hot market. And we took our profits from that and we bought a resort property. And I will tell you 100%, I would not have gotten the property without a traditional agent. Now, obviously, I have a long-standing relationship. Properties were coming on the market every couple of days. We had all of our ducks in a row, and when something we liked came up, my agent was in touch with their agent. We sort of figured out how we had to tweak our offer and sort of where we had to be flexible and where we could ask. And we were able to close. And I will tell you that we're now 2 months later, and when something comes up, they're being listed at $20,000 and $30,000 higher than what we paid. Zillow did not see those listings until 2 or 3 days later, compared to getting them on plain old Realtor.com or through the automatic update from my MLS agent. So I see a lot of potential in Zillow and Redfin, but I feel like it's like, remember when Walmart first started 2-day delivery and like your order would show up in 17 boxes and one piece it would say go to the store? I think there's a lot that we're seeing exposed in this hot market where the system breaks a little bit when it gets 15 offers for everything, and I'm not so sure having an emailed offer is going to be all that beneficial when I've got someone else whose agent is on the phone saying, figuring out if I need to go $800 higher or
Right.
whatever it is.
Anand, how do you feel about that since you're also bullish Redfin? I'm curious.
Sure. I guess for me, it's usually it's kind of like the when we have discussions on FinTwit of very kind of the more arcane the well, how would you allocate your portfolio, and we get into the details. I think they're great for people who haven't bought and sold 17 or 18 houses. By the way, Chris from EXP should have been talking to you, Dan, not Ben. You as a client. But I think that ease for just normal, you see those signs when you're driving around. Call this number if you want to sell your house for cash right now, right? They do that because it can work, right? I think that ease makes it just, even the people who hate Walmart or hate Amazon, you make it easy enough, and it's tempting. And especially when you're time constrained, or you get a new job and you've got 30 days to figure it out, and you have to buy a new house or find a new place in your new market, and you can just get the certainty here. I think there are a lot of use cases like that, and a lot of just, hey, look, I'm not a sophisticated home person. I've only bought one house 15 years ago, and I just want it to be easy. Kind of that selling the CarMax thing, where I know I'm not going to get the best offer from CarMax, but I don't want to go through a private sale. It just makes it easy. And I know I can just get in there, get a reasonable-ish offer, and get the heck out of there.
Yeah, and let me clarify. I'm bullish on both of these companies. I just think the good real estate agents are still going to have a seat at the table. I think what this is going to shake out is the 9 real estate agents I met with before I found the one that I've been using for the last 5 or 6 years. So I do see these companies taking a big piece of the pie, but I don't see them. They're certainly not going to disrupt my relationship with the people I use in real estate. So it's much like retail. There doesn't have to be winner takes all here.
Agree.
Yeah, that's a great point. Let me check and see if also have. I think we have Thomas here. Would like to ask a question. Let me add him as a speaker real quick. Thomas, can you hear us?
Yes, Max. Can you hear me?
What's up, man? Yes, I can hear you.
All right. Good hosting so far. Daniel, I'm not impressed that you didn't even mention arcades. That was the critical mall experience, at least for my childhood. And I would also like to bring up the fact that you said, Corona, you were only closed for a few weeks. That sounds, yeah. I don't believe in Daniels or Simon. And Anand, I've had a bad experience with Zillow. The community, your message boards for these homes. You have genres that say white only neighborhoods in Zillow. Uh, so cut that out. I love Redfin. Uh, if anybody actually heard the last few pitches, I didn't even hear or know of the CEO or this company, but you could definitely hear the actual recommendation of a company that is striving for more. I don't hear that from Anand. He's color coded. If he sees red, he's probably going to shit himself. And Daniel, you are a glut. You should probably be negative.
So, buddy, what is your question? Go ahead.
My question is, why didn't the Redfin Bahamas guy stay longer?
Stay longer. What do you mean stay longer?
Do you not understand that question, Max? And Mark, I'm confused on why you're even here. I was the first one here in this room, by the way.
All right. Well,
I'm
interesting
not sure
question.
what
Not sure
happened.
about that one.
He just got caught, so I'm not sure what's going on, man.
Yeah, it's funny. I'll speak to the silly part of that question is arcades, and I think there's an execution problem at Dave and Buster's, which should be a draw at the mall, but the food is bad. There's just something off with it. So I do think there could be some form of modern arcade, but you are butting up against how awesome the Xbox is. So I think it's a challenge. My son is right now sitting on the couch playing Resident Evil. If for me to say to him, "Hey, let's go to Dave and Buster's and spend more money to play video games," but oh, there'll be mediocre mozzarella sticks there. I don't think right now that's being done well, but I do think there is some sort of let's call it Disney like. There used to be a place at Disney Springs called the Void, which had amazing immersive virtual reality where you were in a Star Wars experience, and there were others, but that was the best one. So I do think that, and I know he was just talking to insult us and not asking a serious question. I do think there will be some place for some variation of an arcade, but I don't think anyone's doing it well right now.
Yeah, really quick. Speaking about Simon Property, I was going over the most recent release, Dan, and I found it pretty interesting about what kind of transformations they are making. And I think they have like a couple of mixed-use redevelopments in Seattle, Washington, and Atlanta, Georgia, like Northgate and Phipps Plaza. And the transformation of Northgate will feature the National Hockey League's Seattle Kraken corporate office and practice and training facility. That's actually pretty cool. Do you
Yeah,
know of any other interesting things like this?
so not specifically, but they don't take a blanket approach. So when they look at each property and they're making the 10-15 year plan, they're looking at population changes, they're looking at needs and demand. So they might say, okay, this mall is actually having population shift away from it, so it might make sense here to have a co-working or to have a big office tenant that's going to bring people, or hey, they're building an arena down the road from this mall, so a hotel would make a lot of sense. This is a company that really, on a local level, understands that it's not one size fits all. So it's not like you're ever going to hear, oh, they're losing 40 JC Penney's, all of them are going to become a blank. You're going to see some of them become distribution centers for Amazon. You're going to see some of them become grocery stores or who knows what. And I think that's the mark of a really smart company, where they're looking at every situation as an individual problem.
Thanks, Dan. Max, you want to do one or two more questions and cut at 30? What do you think? 90 minutes?
Yes,
Okay.
yeah, sounds good to me. I just added Wikipedia as a speaker.
Yeah,
Can you hear
we
us?
kind of moved past it. But I was just thinking that Daniel was talking about and modern arcades and VR, and and I thought that was interesting and something I also believe.
So I was very bullish on it pre-pandemic. But the Void actually went bankrupt during the pandemic because they owed Disney money, and I was very surprised that Disney didn't just take over the intellectual property. This was a $30 experience. I did it a couple of times in Florida and once in Las Vegas. You put on a vest and a helmet, and you literally feel like you're in the scene. There's one that in Las Vegas that was Avengers themed, and basically like you're walking around like you're Iron Man. And I would have paid $30 for that, 10 times a year. And I'm pretty surprised. It seems to me like something that makes an awful lot of sense in the mall or the theme park world. If you go way back in Disney history, they had the idea of mall-based experiences, and they flamed out really quickly. That was, oh God, the 70s or the 80s. But I do think there's going to be room for an innovator there, especially now where even though the malls are healthy, there's much more willingness for a Simon to take a flyer on a business with an idea and make a short-term deal. The days where you have to sign a 5-year contract are over. And in some cases, the malls are being strategic. When Starbucks closed its Teavana coffee chain, some of the Simon malls went out and found local tea shops because they saw that a lot of people were using those cafes. And my guess is they're not paying anywhere near the market value rent, but Simon is smart enough to see that certain businesses are a value add to what they're doing, and they strengthen everything else. The worst thing any mall can have is blank spaces. So if you add more things that people want to do that might get you there, and if you like tea, going to a good tea store might bring you to the mall. I think Simon's been really, really smart about their flexibility and willingness to do that.
Thanks.
Thanks for the question, man. Okay, one more question I have. I just added the one. Can you hear us? Shay one?
Hey, yeah, can you guys hear me?
Yes, we can.
Great, thanks for taking my question. Sorry for what you guys had to deal with earlier there with Thomas. I know you guys are taking time out of your day to talk to us, so appreciate it. My question is, what is stopping Zillow from creating their own direct offer, kind of like Redfin? Is there much in terms of barriers to entry for that, or could they easily recreate what Redfin is trying to do?
They're actually doing it with Zillow offers. So they have, you can go to their site and they'll do, you can see kind of the terms of that and you can go through it. And then additionally, they're trying to do the, get it even more streamlined by one day making it just the Zestimate. So you kind of have the price online. They're testing that in small amounts now. But yeah, no, I mean, I think Open Door, Redfin, and Zillow are all kind of, in different ways playing in that hey, we'll buy your house and we'll sell it kind of space and trying to make it easier.
Follow up on that, just so I'm clear then. So my understanding of Zillow offers is this more like Redfin Now, where Redfin Direct is basically for sale by owner online. Do I have that understanding right, or is there something different there?
I see. I see. I thought you meant directly. I got you. My general thing on Zillow, I think there's a reason I'm kind of bullish on both, is that I think both are going to play in each other's wheelhouses as much as, I think they're very similar, right? Just like an Upwork or a Fiverr or a, Coke and Pepsi, if you want to say that. I think over time there'll be lots of that kind of stuff. I'm bullish on. I think Zillow is willing to do whatever makes financial sense and whatever consumers want, as long as it's a big enough space. You see, like with the rentals, that hey, look, there's I think 60% more number of like leasing transactions than there are home sales in a year. So yes, and those renters eventually become buyers. So yeah, helping someone sell their house easier, I think that's what they want to do, and as long as they can figure out that it's profitable for them, and in the medium to long term, I think they'll do it. But yeah, that's a good point.
Cool. Thanks.
Thanks for the question. All right, I have one more person, and I promise I'm gonna let you guys go. Lion, are you here? Can you hear us?
Hey guys, can you hear me?
Yes, we can.
Okay. Well, I appreciate your time and the information you share here today. It has been awesome content. This is a very interesting industry. Following up on this previous discussion, I had a question for you all. We see that Zillow and Redfin are shifting and focusing on direct buy and sales. We know that Open Door and EXP are already there. So I just wanted to pick your brains and see what are your thoughts on long-term margins and potential differentiation between them. And do you see any type of brand being able to sustain long-term profits and margins, or do you think the industry as a whole might have to decrease margins based on competition? Thanks.
The sorry, I think that 6%, right, the 3% on each side. There's definitely going to be downward pressure there, but I think it's with so many industries where if you've got the platform and you're involved and you're at scale, you're the place people go to help them buy or sell a big dollar item like a house. I think there are creative ways you can make the margins, make your margin, right? Like with banks, you have different regulations that took away how much, what do you call them, overdraft fees, things like that. But they find it in other ways. If interest rates are low, they make sure they can get fees in some other way, because we all want some sort of bank account now. Maybe that gets disrupted by Square and PayPal and things like that, but they'll find ways to make money. Same with like the folks who provide pipes, like the Verizons and the AT&Ts of the world. I remember what was it, more than 10 years ago when Apple was kind of taking, you'd have the cell phone companies kind of subsidizing you to buy an iPhone and being able to pay like $200 on a $600 iPhone. And I thought, oh my gosh, Apple's just taking the value chain out of there. But guess what? Verizon and AT&T have have figured out ways to make sure that they're getting their value there. So for me, kind of the part of the bull case on a Redfin or a Zillow is having that scale and being the brand that you go to, and having those websites and things like that to get you in the door. And I think once you're there, there's especially with a big dollar item like a house where people just don't, a $500 expense when you're buying a small ticket item is huge, right? But in a house, it's a rounding error. And so I think there are lots of ways, especially when you can vertically integrate and take the cost out. It becomes oh wow, we can do title services cheaper than other places because we're at such scale, and even a lower price point for things like that, we can make it. And if our data is really good and we really have your house priced right where we know we can sell it, and we get really good at that, I think all of those things can keep those margins good, even if there's downward pressure on the overall cost.
Thanks,
Dan, do you have
man.
anything to add here?
Yeah, let me jump in because I was going to say something similar. I actually think, speed is what they're going to be selling on the sell your home side. Because I know, as someone who had his condo listed, it cost me roughly $2,500 a month for every month I didn't sell my condo. So I might have taken a lower offer if I could have sold it right away. That's possible. But more importantly, all the rest of the things, I just paid, I don't know, call it $300 for a home inspection. I have no idea what a home inspection should go for. If I could go someplace that it was just all in one, and they're telling me, yep, a home inspection's this, getting your air conditioning fixed is that. I'm still dealing with insurance quotes, and have gone through like 4 companies. If that didn't take me 4 separate emails and conversations, I don't think the price is all that important. So as long as you're getting me in the ballpark, making it easy, that's actually where I think Zillow and Redfin are going to do better than necessarily that 6%, because I actually think 6% is a pretty low cut when you're talking that. And again, if I just paid X hundred thousands of dollars for a house, am I really going to care if my inspection is $320 instead of $349? It just doesn't matter. So there's going to be a lot of money in efficiency on that.
Very interesting take. Thank you both.
Yeah, thank you, Lion, for the question.
Thanks.
Well, I think we're gonna go ahead and wrap it up. We're 90 minutes in.
Announce the next one.
Yes, the next one is gonna be next week on Sunday. Chapter 6 will be dedicated to cybersecurity. We're gonna have Muji talking about industry overall, along with Ned Cloudflare. Also, Chris from Value will be talking about CrowdStrike. So we'll have a lot of great speakers. I think, Mark, we're going to stick with the same format as we did today. That was great. I really enjoyed this. Brings a lot of engagement.
Yeah, if you guys could comment on the post and let us know if you like this better, more like open forum and less speakers and deep dive. I'm curious.